Do you know that nearly 70% of Americans miss out on the opportunity to grow their wealth because they don't invest properly? Here's the question. Is your money working for you, or are you working harder than you need to? Join me on Simply Money as we dive into these concepts now. Welcome back to Simply Money. Investing isn't just for the wealthy. It's the key to building financial independence for anyone. In today's video, I'll break down the basics of investing so you can start making your money work for you, even if you're a complete beginner. But don't tune out if you're a more seasoned investor, because there might be some nuggets for you as well. Many people avoid investing because of fear or misconceptions. Some think it's too risky, while others believe you need a lot of money to get started. The truth, these myths hold people back from unlocking their financial potential. Beginners often struggle with where to start, how much to invest, and which options are right for them. That's why we're here at Simply Money, to help break it down and make it simple for you. There's a lot of noise out there, but you don't have to be scared. Take your time, do your research, and understand that it is not that hard, but you have to do it. You have to be willing to put yourself out there. Let's simplify investing by exploring some beginner-friendly options. I'm going to name 3 different options, and I'm not saying these are the ones you should get. Now, I'm going to precursor this by saying I'm not a financial advisor. This is not financial advice. This is for educational purposes only. Do your own due diligence. But number 1, to understand, what are stocks? Stocks are basically ownership in companies that grow over time. For example, imagine buying a share of a company like Apple or Tesla and benefiting as their value increases. It's that simple. We're just doing it through a brokerage like Fidelity, a Schwab, or M1. It'd be no different than your friend coming and saying, I want you to help me start a business. I need you to help fund me. Do you have some money you'd like to invest? I'll give you part ownership. And as the profits grow, your shares will grow as well. So if your share is worth $100 and the company's worth $10,000, now the company's worth $100,000, your share's worth $1,000. You grow with the company. We don't think of it that way a lot of times with stocks because we don't see the company. We're not involved in the company, and they're way bigger than our friend or our neighbor starting a business and us getting part ownership in it. But that's all it is. And key concepts to look for is the beta, which measures its volatility compared to the market. A beta of 1 means the stock moves with the market. Higher than 1 indicates more risk. Lower than 1 means less volatility, the amount it moves. 1 is the baseline. The S&P 500 is the baseline. Above 1 means it goes higher and lower than the market does as the market moves. So look at that. It'll help you while you're assessing your risk tolerability. The second investment is bonds. This is for those that want to have a more stable, less volatile, and less opportunity. I will say that. Bonds are loans you give to companies or governments in exchange for steady interest payments. For example, a U.S. Treasury bond, often considered one of the safest investments. You're basically loaning the U.S. government money, and they're going to pay you back with a set interest. 4%, 5%, whatever it might be. The steady interest is something that is attractive to many investors. It doesn't have the large upside of stocks, particularly large growth stocks like Apple, Microsoft, etc. With bonds, one of the key concepts is they have a yield, which shows the return you can expect from your investment, usually expressed as a percentage. Yield and percentage is going to be the same thing. So your yield might be 5%. Think about getting a CD. It says your interest will be 5%. Over 6 months, 12 months, however long the CD is. A bond works very similar. They typically have some fluctuation with the market as well, but this is what you can expect. The third investment and we're going to give kind of twofold here, is mutual funds or ETFs. And I'll break these down in a moment, but they're both are a collection of stocks, bonds, or other assets managed professionally. Think of it as stocks. You have Apple, Microsoft, Nvidia, all these different stocks, and you take them and you put them in one bundle, and you call that whatever the ETF or mutual fund's name is. Give you an example, something like FXAIX. It's made up of 500 of these companies. And so this one fund, now you're actually buying a little piece of all of those companies. And this allows you to diversify your portfolio with one investment. Say you have $100, instead of having to buy $7 worth of Apple, $5 worth of Amazon, $4 of Nvidia, $3 of et cetera, until that $100 has been spread out to all 500 companies. And as you can see, the top companies, you're putting a bigger percentage, and the lower companies, which you don't see, you're only putting like fractions of pennies in that $100 scenario, because it is diversified based on the value of those companies. The difference between a mutual fund and an ETF is a mutual fund, even though they both are made up of multiple stocks, a mutual fund is actively managed by a team of professionals who aim to outperform the market. They often have higher fees, but may align with specific goals. And my favorite and my recommendation is ETFs, which stands for Exchange Traded Funds. These are passively managed funds that track an index like the S&P 500, for example, what I just shared, FXAIX, and often with lower fees. And that's what I recommend, index funds, ETFs, because they're following a index and they're managing passively. They're cheaper and they usually outperform the mutual funds. When choosing a mutual fund or an ETF, and the reason I'm sharing mutual funds is because if you have a company 401k, a 403b, you are usually limited to what they offer inside of there, and it's typically mutual funds. So you may have to have mutual funds to make sure you're getting your company match, or because that's all you have available. But if you're in a Roth or a traditional IRA, just a brokerage account, you have availability of all these different stocks, bonds, ETFs, mutual funds, and you have more control over it. That's where I would like to see you with ETFs or index funds. But mutual funds sometimes is the way you have to go because it's all that's available, and it's okay. They're not horrible. I just think ETFs are better. But when choosing either mutual fund or ETF, here are some key factors to understand. These are the things I want you, if you don't understand these concepts, this is where I want you to start doing your homework, not just listening to this video, but digging in and doing some reading, listening to other videos that are strictly about each of these topics. So the first is expense ratio. If you don't understand what that is at the end of this video, go read up on expense ratios with ETFs and mutual funds. If you don't understand these, go watch a video that is strictly teaching on what that is, that goes into much more detail to help you. That's okay. Take each of these one at a time and really get educated on them. Expense ratio. All this is the annual cost of managing a fund, and it's expressed as a percentage, and lower expense ratios means you keep more of your returns. One of my favorites, SCHD, is 0.06. That's how much the fee is. I have one that I have to have. It's in a 403B, and the expense ratio is 9. That's a big difference. More of the money's not going to me and the compounding, but going to the managers of the fund. I don't have a choice in that 403B. So I have a mutual fund, and that's the fee I have to pay. But understand them, so when you do have choices, you can look at that, because you might look at the rate of return. They'll say, look how good this has performed over 5 or 10 years. But then you look at the expense ratio and you realize, well, a lot of that's going to be eaten up by the expense. Not to get overly concerned with that, because most of these now have become much more reasonable, but sometimes you have to watch out. There are those hidden expense ratios that you have to be aware of. So that's number one. Number two is holdings. So when you're thinking of a mutual fund or an ETF, remember when they say holdings, it just means what stocks are made up in there. So think of the holdings like you're going into your cookie jar. I go to my grandma's house when I was a kid, and I'm going to get the ETF, which is the cookie jar. And we're going to just call that whatever name you want to give it. That cookie jar is the ETF or the mutual fund. And I want to see what my grandma's cookie jar is holding. What are the holdings in there? Maybe there's some chocolate chip. Maybe there's some oatmeal. Maybe there's some molasses. For those of you that are younger, that was grandma's specialty, molasses cookies. Anyways, those are individual holdings inside the cookie jar. So the ETF mutual fund is the cookie jar, and you have Tesla, you have Nvidia, you have Apple. Those are the holdings inside of the cookie jar. That's all that means, the individual assets within the fund. And that is what you want to make sure you understand. What are the holdings? That's number two. Number three, sectors. Now, this one's going to be a little bit, maybe I'm stretching my cookie analogy here, but I'm going to go for it. Maybe you have chocolate chip and you have oatmeal chocolate chip. They're both in the chocolate chip sector. They're different, but they're in the sector. Then you have peanut butter and you have chocolate peanut butter. They're both in the peanut butter sector. Sectors are the industries represented in the fund, such as technology is one sector, healthcare is another sector, or energy. These are different sectors. And sectors, you want to be diversified across sectors to reduce risk. If you're all in technology and technology goes down, you don't have anything to help balance that. So sectors, that's your third thing to understand. You want to know expense ratio, holdings, and sectors. The fourth thing is yield. Similar to bonds, funds often have a yield. I've used SCHD as an example. SCHD has 104 holdings. It has many sectors, and it's balanced within those. You have technology, healthcare, financial, consumer staples, and it has a 3.5, currently 3.5 yield. A yield, for example, a high yield dividend ETF might focus on stocks that pay a regular dividend to drive up a higher yield. Where you may have something that's more on growth and they're not paying out dividends, so it has a lower yield. Understanding what the yield is lets you know how much dividend, how much payment you're going to get. So understand those four concepts. I think those are your beginning baseline concepts to make sure you truly understand before picking a mutual fund or ETF. Now, once you have those down, we're going to go into key concepts to build your confidence, because you're maybe scratching the surface. Okay, I understand expense ratios, understand holdings, sectors, and yield, but I'm still feeling a little bit nervous. We're going to build your confidence with these terms and these concepts. One, diversification. Spread your investments across different assets, sectors, geographical regions to reduce risk. Understand diversification. Again, once you've mastered and understand fully those first four terms, I want you to go into these next four concepts to better build your confidence in picking the right fund. Diversification, how you're spreading across your risk. A lot of people confuse saying, I'm diversified. I have 100. I'll give you an example. SOXX. It's a great great ETF that I own. I'm not saying to go buy it. It's diversified slightly with 30 different holdings, 30 different companies, but it's all in one sector. It's all technology. So it's not diversified in sector. If you're just beginning, you want to make sure you're diversified with your holdings and your sectors. But you also want to look at, are all the sectors US or are they international? You want to make sure all of this type of diversification comes into play and you understand that and they meet your goals, not my goals, your goals. Number two, confidence building key term is risk tolerance. How comfortable are you with market ups and downs? If you're conservative, you might prefer bonds or dividend-paying stocks because the roller coaster, as Dave Ramsey said, the only person that gets hurt on a roller coaster is the person that jumps off. When you're going up, I love Cedar Point, Millennium Force, this big first ramp. It's going up. You come to the top, and your adrenaline, you're so excited. This is going to be so amazing. Just like the stocks are going up, you buy it. Oh, look, it's green. It's going up. You're so excited. Your adrenaline's pumping. And you come up over that top. You're looking out over Lake Erie, amazing views, and you look straight down, almost a 90-degree drop. You're hundreds of feet up in the air. You know you're about to go crashing down. Now, those that are roller coaster enthusiasts, you're sitting there going, yeah, that's when the excitement is. Well, guess what? On the stock market, you have those that are going, yes, there's a dip. I'm buying more. I'm okay with that. I'm excited. It doesn't bother me. It's part of the thrill. And you have others that are about to throw up. They're dying. They're like, get me off of this ride. It comes over that hill and they're about to die. They're turning green. And that's how risk tolerance plays with people in the stock market. There's those that love the ups and downs. There's those that only like the up and they can't handle the down. You and only you know your risk tolerance. You need to understand that when you're deciding on how to invest. That's concept number 2 to build your confidence. Concept number 3 is time horizon. The longer you have to leave your money invested, the more risk you remove and the more risk you can take for potentially higher rewards. Time horizon is important. That's why there's not a one-size-fits-all. And if you jump on YouTube or read a book and it talks about how to invest and they're not mentioning your time horizon, they're not doing you a service. Because I tell a buddy of mine all the time, he's 30-something years old, like, dude, chill. You got so much time. You're going to go through, you think this dip's bad? You're going to go through 5, 6, 7, 8 more of those. You're going to have more dips, and some of them are going to be bigger than this dip. Chill out. Relax. Stay the course. You got this. But if you're 65 and you're about to retire, I'm not going to be like, hey, chill out, relax. I'm going to be like, make sure you're ready and you've diversified and you've taken some of that risk out and that you're in a place where you're ready to handle short-term stuff differently because you don't have 30 years to ride this out. You're here using this money now. It's a different story. So you need to know your time horizon. Maybe you're 25, but you want to hit fire and be financially independent when you're 35. That's a different story again. So everybody has a unique time horizon, and you need to figure that out. So number 3 is time horizon. And I've mentioned this one before, and this is important, and this will build your confidence, is understanding the beta. And this kind of goes with your risk tolerance and your time horizon. But what is the beta? As mentioned earlier, it's the measure of the volatility of your investments. For example, an ETF with a beta of 0.8 would be less volatile than the market. That's what SCHD is. It's less volatile because it's more focused on income, and that's okay. So you need to understand what beta is and how it works. That'll build your confidence when you're picking a stock or picking an ETF. If you go into it and you don't know the beta, and the beta is 1.6, then all of a sudden you see it doing this, you're going to be freaking out. But if you know that in advance and you understand that, and it's part of your risk tolerance and part of your diversification and fits in your time horizon, you can be like, hey, this is good. This is part of the roller coaster. I'm excited. I waited in line for years. I'm going on this ride, and it's going to be awesome. Those are the terms that'll build your confidence. So understand these terms, and it'll help make informed decisions and align your investments with your financial goals. The real power of investing lies in compound interest, earning interest on interest. For example, if you invest $100 and it's earning 8% annually, you could have over $150,000 in 30 years. I know that may not seem like a lot, but you're only investing $100 a month. That is a lot of money to end up with. That's the power of compounding. There's lots of videos on the site. Check it out on the channel on compound interest, investing early versus waiting. lots of different topics. Check those out and see the power of compounding. If you want to see a good one, check out the SCHD video I did showing an update on a hypothetical portfolio of how much it's grown in number of years and showing the ups and downs. It touches on a lot of these points of the risk tolerance, of the time horizon, of the beta. It shows a lot of this and shows you the power of compound interest. Investing doesn't have to be complicated or intimidating. So by understanding the basics of stocks, bonds, mutual funds, and ETFs, and key terms like beta, yield, sector, and holdings, you can make informed decisions and watch your money grow. What's your biggest question about investing? Drop a comment below and I'll address it in an upcoming video. And don't forget to check out some of the other videos on the channel. And if you like this video, hit that like and subscribe button, and we'll see you next time on Simply Money.